If you're over 60, or if you have a parent or grandparent who handles their own finances, you need to hear this right now. Most people don't find out about this change until they're sitting across from their bank teller, or worse, until they get a letter from the IRS in the mail. And by then, it's already too late to avoid the headache. So stay with me for a minute, because what I'm about to explain could save you from a very stressful situation, and possibly save you from paying money you never should have owed in the first place. We're talking about the $10,000 rule. You've probably heard that phrase before. Maybe someone mentioned it at the dinner table, or you caught a headline about it online, or your neighbor told you the bank reported them for something and you weren't sure what that meant. Well, in 2026, the IRS has made some important updates around this rule. Updates that directly affect how your bank handles your money, how the IRS monitors cash activity, and what you as a senior need to know before you make your next large withdrawal or deposit. This isn't about doing anything wrong. This is about knowing the rules so they don't catch you off guard. Let me start from the very beginning, because I think it's important to understand where this rule even came from before we talk about what's changing. Back in 1970, Congress passed something called the Bank Secrecy Act. Now, this wasn't aimed at ordinary people. The whole idea behind it was to give the federal government a way to track large amounts of cash that were moving through the financial system. Because at the time, organized crime, drug trafficking, and tax evasion were becoming serious problems. People were moving huge sums of money around in cash to avoid leaving a paper trail. So the government said, okay, we need banks to start keeping records and reporting certain transactions to us. And that's where the $10,000 rule was born. Here's how it works in simple terms. If you walk into a bank and deposit $10,000 in cash, or withdraw $10,000 in cash, your bank is legally required to file what's called a Currency Transaction Report, or a CTR, with the federal government. This happens automatically. You don't get a warning. You don't have to sign anything extra. The bank just does it. And the IRS, the Treasury Department, and the Financial Crimes Enforcement Network, a group called FinCEN, they all receive that report. Now, this might already make you a little uncomfortable, and I understand that. The idea that your bank is reporting your transaction to the government without telling you can feel like an invasion of privacy. But here's what a lot of people don't realize. This report by itself doesn't mean you're in trouble. It doesn't trigger an audit. It doesn't mean someone is investigating you. It's just a record. Think of it like a receipt that the government keeps on file. For most people, nothing ever comes of it. But, and this is a big but, there's a second part of this rule that gets a lot more people in trouble, and it's called structuring. Stay with me here, because this part is really important. Structuring is when someone deliberately breaks up large cash transactions into smaller ones, specifically to avoid triggering that $10,000 reporting requirement. So let's say you have $12,000 in cash and you think to yourself, I don't want the bank to report this, so I'll deposit $9,000 today and $3,000 next week. That, under federal law, is a crime. Even if the money is completely legitimate, even if you earned every dollar honestly, the act of intentionally splitting up deposits to stay under the $10,000 threshold is called structuring, and it's illegal under the Bank Secrecy Act. I know, that surprises a lot of people. And honestly, it surprises me too when I think about how many seniors get caught in this situation without ever meaning to break any rule. They're not laundering money. They're not hiding anything. They just don't want the government in their business. Or they heard somewhere that deposits under $10,000 don't get reported, and they figured they were being smart. But the IRS doesn't see it that way, and that's exactly why this matters so much in 2026. Let me give you a real example so this really lands. Imagine a woman named Dorothy. She's 74 years old, retired, lives in Florida. She sold some antique furniture that had been in her family for years, a beautiful old dining set that she didn't have room for anymore. She got $14,000 for it, all in cash. Now, Dorothy knows herself. She's careful with money. She doesn't want to walk into the bank with all that cash at once, so she deposits $8,000 one week and $6,000 the following Monday. She thinks she's being responsible. She thinks she's staying under the radar. But here's what happens. Banks don't just file reports on single transactions over $10,000. They're also trained to look for patterns. Tellers are required to flag behavior that looks like someone might be trying to avoid that reporting threshold. Dorothy's two deposits, made close together, both just under $10,000, raise a flag. The bank files what's called a Suspicious Activity Report, a SAR. Now, Dorothy is in the system. She might get a letter, she might get a call, she might face a visit or an audit, not because she did anything dishonest, but because she didn't know the rules. That's the situation I want you to avoid. Now let's talk about what specifically changed in 2026, because this is the part that's catching so many people off guard this year. For decades, the $10,000 threshold stayed exactly the same. $10,000 set in 1970 never adjusted for inflation. Think about that for a second. $10,000 in 1970 is worth roughly $80,000 in today's money. So in real terms, the reporting threshold has actually been getting lower and lower every single year when you account for the cost of living. More and more ordinary transactions have been getting swept up into this reporting system simply because prices have gone up. The IRS and Treasury have been under pressure for years to modernize the rules, and in 2026, some of that pressure has resulted in real changes, but not necessarily the changes that help you. In fact, some of what's happening this year makes things more complicated, not less. Let me explain. First, there have been updated guidance and enforcement priorities around digital payments and peer-to-peer transfers. You know apps like Venmo, PayPal, Zelle, Cash App? These have been quietly pulled further into the same reporting framework as traditional cash transactions. If you're a senior who uses these apps, and more seniors are using them every year, which is wonderful, you need to know that large transfers through these platforms are now being monitored and reported with much greater intensity than they were even 2 or 3 years ago. Here's what a lot of people don't realize. The IRS already lowered the reporting threshold for third-party payment platforms back in 2022, down to just $600 for business-related payments. In 2026, enforcement around this has become much stricter. So if you're selling things on Facebook Marketplace, getting paid for occasional services, receiving money from adult children through Venmo, or running any kind of small informal business, even baking cakes for neighbors, even selling crafts, those payments could be triggering tax reporting obligations that you might not even be aware of. Now, I want to be really clear here because I don't want to cause unnecessary panic. Receiving money from your kids through Zelle because they're helping with groceries is not a taxable event. A gift is not income. But if the IRS sees regular large transfers coming into your account and they don't have context for what those payments are, that can raise questions. And questions from the IRS are never fun to deal with. Let's take a step back for a moment and talk about why all of this hits seniors especially hard. A lot of people in their 60s, 70s, and 80s grew up in an era where cash was king, where you kept money in a safe at home, or you made large withdrawals to pay contractors, or you carried cash to the car dealership, or you kept money under the mattress. Not because you were hiding anything, but because that's just how things were done. There was a culture of privacy around money that was completely normal. And there was also a deep distrust of financial institutions that, for many communities, was completely earned. But the rules today don't give a lot of credit to those old habits. The banking system in 2026 is a surveillance system in many ways. Every large transaction is tracked, every unusual pattern is flagged, and the burden of explaining yourself often falls on the account holder, meaning you. This is also the time I need to warn you about something else. Because wherever there are new financial rules, there are scammers waiting to take advantage of confused and worried people. In the past year, there has been a massive spike in phone and email scams targeting seniors around exactly this topic. You might get a call from someone claiming to be from the IRS, telling you that your account has been flagged for large cash activity and that you owe back taxes or penalties. They'll sound official. They'll use terms like currency transaction report and financial crimes enforcement network to sound legitimate. They'll create urgency. They'll tell you that if you don't pay immediately, in gift cards, wire transfer, or cryptocurrency, you'll be arrested or have your Social Security benefits suspended. I need you to hear this clearly. The IRS does not call you out of the blue. The IRS does not demand immediate payment over the phone. The IRS does not threaten arrest for unpaid taxes without first sending you multiple letters through the mail. If you get a call like this, hang up. Don't engage. Don't give them any information. And if you're worried, you can always call the IRS directly at their official number, 1-800-829-1040, to check whether there are any actual issues with your account. Real IRS notices come in the mail. They give you time to respond. They include specific instructions and case numbers. Panic and urgency are the tools of scammers, not the IRS. Now let's talk about what you should actually do to protect yourself and stay on the right side of these rules in 2026. The first thing, and this is the most practical piece of advice I can give you, is to simply be transparent. If you're going to make a large cash transaction, just make it. Don't split it up. Don't try to avoid the threshold. Let the bank file its currency transaction report if it needs to. As long as the money is legitimate, that report goes into a file somewhere, and nothing ever comes of it for the vast majority of people. The report is not the problem. The attempt to avoid the report is the problem. If you've recently sold a home, received an inheritance, sold a vehicle, or received a settlement, and you're about to deposit a large amount of cash, it's worth having a brief conversation with your bank ahead of time. You can literally walk up to a teller or manager and say, "I'm going to be depositing a large amount of cash that came from the sale of my house, and I just wanted to let you know." That simple step creates context. It can prevent a suspicious activity report from being filed, and it shows that you have nothing to hide. The second thing is to keep records. I cannot stress this enough. If you receive cash from selling something, a car, jewelry, furniture, property, keep a receipt, a signed bill of sale, a text message, an email, anything that documents where that money came from. If the IRS ever asks, you want to be able to answer quickly and clearly. A paper trail is your best protection. Third, if you use any payment apps like Venmo or PayPal, go through your transaction history and think about whether any of those payments might look like business income to an outside observer. If you've been receiving regular payments for any kind of service or sale, you may want to talk to a tax professional about whether any of that needs to be reported. It's much easier to get ahead of this than to deal with it after the fact. And fourth, please talk to a CPA or an enrolled agent if you have any uncertainty. I know some people are put off by the cost or the idea of sitting across from an accountant feels intimidating, but a 1-hour consultation with a tax professional could save you from a very expensive and emotionally draining audit. Many accountants offer free initial consultations. If you're on a fixed income, there are also free tax assistance programs available through the IRS called VITA, Volunteer Income Tax Assistance, and AARP also runs a tax aid program specifically for seniors. These are real resources, staffed by trained volunteers, and they are completely free. Now, I want to spend just a moment talking about the bigger picture here, because I think it matters for your peace of mind. The IRS is not sitting in a room somewhere looking for reasons to go after retirees. That is not what this is. The people who get in real trouble under these rules are people who are intentionally trying to hide money. Large-scale tax cheats, money launderers, people moving illegal income through the financial system. For ordinary people with ordinary financial lives, these rules mostly operate in the background and never cause any direct problems. But And I keep coming back to this because it's so important. Ignorance of the rules doesn't protect you from them. If you accidentally structure deposits, even with zero criminal intent, you can still face serious legal and financial consequences. The law doesn't require that you intended to do something wrong. It just requires that you did it. That's what makes this so important to understand. The 2026 updates are a reminder that the financial world is changing fast. Digital payments are being tracked more closely than ever. Banks are more sophisticated in their monitoring. The IRS has invested heavily in technology that can spot patterns across millions of accounts simultaneously. This isn't the 1990s where a cash deposit got written in a ledger somewhere and forgotten. Everything is connected now. And for seniors who may not have grown up with this kind of financial surveillance, who may be more comfortable with cash, who may be managing larger amounts of money due to selling a home, receiving an inheritance, or drawing down retirement accounts, the risk of accidentally running into these rules is higher than ever. The good news is that the fix is simple. Be straightforward, keep records, don't try to stay under the radar. And if anything feels confusing or uncertain, ask for help before you act, not after. Because here's the thing. You've worked your whole life for the money you have. You've paid your taxes, you've played by the rules, you've done everything right. The last thing you deserve is to have a misunderstanding about a banking rule turn into a legal headache or a tax bill that wasn't even warranted. You deserve to understand the system that's managing your money. You deserve to know your rights and your responsibilities. And you deserve to go into 2026 feeling informed and confident rather than worried and confused. So please, share this with someone who needs to hear it. Share it with your spouse, your adult children, your friends at church, or in your community. A lot of people are completely unaware that these rules exist, let alone that they've been updated. The more people know, the fewer people get caught off guard. Check your own accounts. Think about any large transactions you've made or are planning to make in the next few months. If anything feels uncertain, reach out to a tax professional or your bank's manager for a quick conversation. And stay away from anyone who calls you, emails you, or contacts you claiming to be from the IRS and demanding immediate payment for anything. You've worked too hard for too long to let any of this catch you by surprise. Don't leave money on the table. Don't leave yourself vulnerable to rules you didn't know existed. Stay informed, stay protected, and share this with someone who needs to hear it today.